Good morning. My name is Ricardo Grillo, and I will be presenting an algorithmic long-term strategy that I have been developing over the last 4 years. This presentation is going to take close to half an hour, and I think that the first 10 minutes will be enough for you to decide whether it interests you or not. Therefore, please give me 10 minutes of your time. Okay, well, the idea for this strategy started about 4 years ago, a little before the end of Warren Buffett's famous bet. Some would say infamous. At that time, in discussions on the web, several times I heard the same question. If it is true that the plain index is more profitable than all hedge funds, what about a ×2 ETF of the index? Would it be twice as profitable? No, it is not. If you go to a ×2 ETF, you will be doubling alpha, but you will also be doubling beta. Therefore, you will be in the same place. By the way, with beta here, I am not referring to beta return. I am talking about the beta factor that expresses the risk in your portfolio when it is compared to the benchmark. So, like I said, there were some people asking whether we could improve the index performance if we went ×2. But then I kept thinking, okay, we cannot do that. But would it be possible to improve the ratio between alpha and beta by using the leveraged instruments that are available today in the market? And here, let me comment a few things about the beta factor. The beta factor is supposed to determine how risky your portfolio is with relation to the index. Like, if beta is 1.5, it means that your portfolio is 50% riskier than the index. And according to the modern portfolio theory, it should return at least 50% more than the index. I personally have many problems with the modern portfolio theory, but still some of their metrics and guidelines are pretty good. Like, if the index closes a year with 10%, that portfolio should return at least 15%. Otherwise, it is not worth it. Now, the common way to evaluate the risk of a portfolio is to assess the volatility and compare it with the benchmark. However, when you deal with the index, assessing the high-frequency volatility does not give you a good picture of the risk. There is something very special about the risk of an index that must be taken into account. When you assess the risk of an index, you apply a hypothesis which cannot be applied for a stock or a portfolio instrument. This hypothesis is the belief that the index will keep on trending up for the rest of our lifetime. You cannot say that about a stock. A stock may go up, it may go down, and it may even go bankrupt. However, I dare say that maybe 99% of all economists and finance professionals, including myself, believe that the index will keep going up and up. Of course, nobody can see the future. So you have to decide if you believe this or not. But in this presentation, let's assume for a minute that we all believe that. So, if this is the case, where is the risk? There is no risk. No. Actually, there is. And this is why, on the one hand, the index has to its advantage that it always moves up. But on the other hand, the index presents the terrible tragedy of the major corrections. Sometimes corrections, sometimes recessions, and sometimes depression. And if you review the index progress over the last 70 years, you will see that there is a relationship between the correction depth and the time it takes for it to recover. That is the actual risk that you incur when you put your money in the index. And it has nothing to do with the daily volatility, month volatility, or year volatility. As a matter of fact, see how bizarre. If you calculate the daily volatility for the Dow Jones, you verify that it is much higher than the S&P. However, I would not say that the Dow Jones index is riskier. No. Very likely this difference in volatility is related to the manner the index is constructed. Probably because the Dow encompasses a smaller number of stocks, it shows more fluctuation or such. But it does not mean it is riskier. Therefore, the risk for an index is not determined by the daily or weekly volatility. Actually, in order to assess and compare the risk, you must get the index, filter off all high-frequency volatility and leave only the major corrections. And when I do this to the S&P historical data for the last 70 years, I find that I have a total of 31 corrections, which are over 8% dip. Okay, and now that we have understood and have agreed on what our investment real risk is, I can determine what the beta factor for my strategy is with relation to the S&P 500. So, this is what I want my strategy to accomplish. You see? And my beta factor will be the ratio between the depth of the red line and the depth of the blue line. So suppose that I develop a strategy that behaves practically the same as the index outside the pit. And in the pit, it only goes down a depth which is 2/3 of the index correction. And this for the same alpha. I mean for the same yearly return. In this case, my beta will be 0.66. Therefore, based on these boundary conditions, I started working on this strategy, an algorithmic, 100% mechanic strategy that accomplishes these goals. So, in order to achieve that, the first thing I had to do is to increase my number of occurrences, which is my number of cases, or the number of major corrections. Like I said, if I traverse the whole 70 years of the S&P, I have 31 major corrections. However, 31 points or 31 occurrences is not enough for a reliable statistical assessment in an algorithmic approach. I need at least 3 times this much, at least about 40 points in my sample, which I will use to develop the strategy, and another 40 for backtesting. So, what I did was to collect all major corrections in the S&P, NASDAQ, and the Dow since 1915 and the DAX index. And besides, I also made up about 20 quote-unquote corrections, using several depths, length and time, and the shape as to the way it goes down and the way it recovers. And so I had all I needed to develop the strategy. And this is what I came up with. This chart is not very clear. Maybe you can see that the shape of the curves for the index and the strategy are very close to each other outside of the corrections. Only minor differences. And you may also be able to observe that whenever you have a correction, the strategy dips less than the index. Like here, here, and here. Here is an enlarged detail of the whole chart. See how the drawdowns are shallower for the orange line, which is the strategy. We can see it better on this table. Now let me comment a few things on this table. Okay, on this table I only listed the results from the S&P from 1950 to the present. And they are sorted by the correction depth, not by the sequence and time. And like I said, we have 31 occurrences. Here I have, for each correction, the drawdown of the index, the drawdown of the strategy, and the beta factor. All right. The first thing that I noticed for this strategy is that when I observe these 31 occurrences and also all the other occurrences that were analyzed from the other indices, the beta factor is pretty much a function of the correction depth. In other words, I cannot specify the beta factor by one discrete number, but rather by a function. Here, for example, for the corrections between 8 and 19%, for all indices, the beta factor will be more or less between 0.95 and 0.99. And here, for example, between 19 and 45%, the beta factor is around 0.65. And if you go above 45% correction, beta goes back to 0.80 and 0.90. Now, again, only focusing on the 31 occurrences of the S&P from 1950 to 2020, here is the chart that I get. Let's pay attention to this chart. Like I said, the alpha for the strategy in 70 years is 0. In my strategy, this means that I am applying leverage equal to 1. It returns just like the same as the index, which is the average of 7.85% per year. Okay, but you see here that for a drawdown from 19% to 45%, beta is somewhere between 0.6 and 0.7. So, if you invest on the strategy, you will be earning the same as the index, with much shallower drawdowns. Let me put it this way. Suppose you use this strategy for your 401k. One day you get to work and your friends will say, Wow, my balance went down 35%. And you are going to answer, my strategy profits the same as yours, but my balance only went down 20%. So this is not bad. But we have two problems here. You see here, that on the range from 8 to 19%, the strategy does not give you any additional protection. It practically behaves like the index. And even worse, look here. If the correction goes over 45%, again, you get very little protection. Your beta will be around 0.8 or 0.9. So, in a nutshell, the strategy gives you the same returns as the index. It gives you much shallower drawdowns for corrections between 19 and 45, but does not help you much for corrections less than 19 or greater than 45. Okay, let's first focus on the range between 8 and 19. So the 401k guy that I mentioned before, for corrections less than 19, is going to undergo the same drawdowns as the index. However, it is very likely that he will not consider this much of a big deal. Okay, he has the same drawdown as the index, but the drawdown in itself is small. I am talking about 19% most, so it is a range where I don't need much protection in the first place. It's just 19% drawdown. Therefore, the 401k guy is still happy. Now, how about the corrections above 45%? Well, for this range, there are two things to be considered. Okay, the first one is this. Remember that I mentioned the hypothesis about the index ever uptrend, and that it is adhered to by about 98% of the whole world? Now there is another hypothesis which is adopted by maybe 50 or 60% of the economists in the world. And the hypothesis is that, in our lifetime, we shall never see again a market correction greater than 45%. Think about it. Would you agree with this? Here is how they explain it. As you guys know, in the year 2K we had the dot-com crisis and a correction of 49%. And just as this correction was ending, in 2008, we had the subprime crisis with a 57% correction. These two crises in a row were dramatically damaging not only for the economy but for all aspects of mankind in the whole world. Some scholars even say that the year of 2008 got very close to the total obliteration of the whole Western civilization. You guys may remember that after Lehman Brothers filed for bankruptcy, in another 2 or 3 days, there were a big list of major financial companies lining up to do the same, and among them AIG. And at this point, the Fed set aside all their traditional principles and started a major plan to bail all of them out. And we know, if AIG went under, we were going to have a domino effect that would impact the whole world. Well, after that major tragedy, we have been seeing a major change in the discourse of all central banks in the world, and even all governments. And I would say all international institutions like the World Bank, IMF, etc. I see it like something similar to a vow, perhaps a pact, something like an unspoken promise that they won't let this happen again. And basically, this is what we have been seeing now with the COVID-19 crisis. In the present situation, people would say that the Fed ran out of weapons to fight the recession. The interest rates are already practically zero. They have already spent more than $2 trillion on QE, so they won't do anything more. However, their message is that they will do whatever it takes. Negative interest rates extend the QE for corporate bonds and even corporate stocks. This basically means that the Fed would take a trip, get to the New York Stock Exchange, and buy stocks of Apple, Bank of America, and such. And today the Central Bank of Japan is already doing all that, buying corporate stocks, negative interest rates. And I don't know if it was a joke, but I heard that they even consider helicopter money. Therefore, with the current crisis, we will be able to see whether belief number 2 sticks or not. Therefore, if the 401k guy adheres to this belief, he just does not care that the strategy won't protect him over a 45% correction. Now the second thing to be considered, actually, Even if the 401k guy does not adhere to belief number 2, he may not care either. And this is why, whether you invest on the index as a 401k investor, a broker, a hedge fund, or an institution, you must be aware of its sweet and sour characteristics. The sweet part, it always goes up, up, up. And sour, major drawdowns. And you should be prepared. For example, a 401k guy invests for a 20-year or 30-year period. Okay? That does not mean that he is not supposed to touch that money until he retires. For example, during the subprime recovery, I know of a case in which the 401k account was 35% down, but the real estate prices in that city was about 65% down. So, this friend of mine decided to buy this really big house, but he didn't have the down payment money. So he withdrew from his 401k, because even with the penalties and the taxes and the 35% correction, it was very worth it. He just could not let that chance pass by. Well, possibly, with my strategy, instead of 35% down, his balance would be only 20% down or something. So there always is the possibility for you to need your money during a crisis. However, it is really hard to believe that someone would consider withdrawing from an investment based on the index during a correction over 45%. I personally would have this mindset. If my investment is 45% down, I don't care if it is 45, 55, or 65. It wouldn't make a difference because I am not going to touch that money until the crisis is over. You understand? So, what I am saying is that even if the 401k guy does not adhere to belief number 2, the fact that he is not being protected for dips over 45% may not be relevant for him. Now let me make a few comments concerning this strategy when applied by 401k guys, brokers, institutions, and hedge funds. I'm going to start with hedge funds. Well, this strategy, at this level of leverage, gives you less risk and the same average return as the index, which is 7.85%. Well, when I think of hedge funds, I rather think of returns like 25%, 30%, or even 40%. Unfortunately, this definitely has not been the case over the last 5 years. But this is another story. So, the question is this: would a strategy like this be applicable to a hedge fund portfolio? The answer is yes. And here's why. As far as we can have access to, I would say that 90% of all hedge fund portfolios have a major percentage of their funds on index-related investments. And this is for several reasons. First, the behavior of the indices is much more predictable than other instruments. Therefore, having some money on the index serves like a buffer in times of uncertainty. And besides, at least in theory, a hedge fund does hedge. I don't know how much this is true in real life, but in principle, a hedge fund should be shorting perhaps around 50% of their portfolio. And once again, leaving some money long on the index serves as a buffer for possible losses. Now, concerning this strategy, there are 2 other points that the hedge fund managers should consider. Okay, so first let's talk about the last 5 years. Well, during this time, the hedge funds have been seeing a huge money outflow. I don't want to number numbers here, but I hear things like 50% or even more. And why is that? On one side, it is obvious that it is due to the poor performance in these years. For the hedge funds, these were 5 red years. Yes, I am talking about red. But on the other hand, we had Warren Buffett's bet, which was terribly damaging. I could discuss here that Warren Buffett's bet was not totally fair, but this would be another discussion. But I believe that many LPs that left the hedge funds now put at least part of these funds into the index. Therefore, if you go back to them and say, hey, here I have this strategy that works just like the S&P 500, but better, you are going to catch their attention. Now, the second point, remember that this is an algorithmic strategy, 100% mechanic. And I want to remark that one of the upsides of the algorithmic approach is the fact that it makes it much easier for you to explain and to demonstrate what is the expected behavior and performance of it. When you try to sell a discretionary approach, even if you know that it is very, very good, sound and reliable, you will have to somehow demonstrate to the buyer that the manager has an outstanding personal capacity and that relying on his skills makes complete sense. Correct? For a strategy like this is not necessary. Rather, you are going to sit down with your client and you will go through all corrections from the past and see how that the strategy performed. Next, you are going to ask the client to come up with all the weirdest shapes for all kinds of possible corrections in terms of depth, duration, how it goes down, how it comes up, the number of double dips, etc., to his heart's content. And then you will run the strategy for each one of those scenarios and show him the results. Do you notice how easier it is to gain the client's trust? The human component is very much reduced. Things don't change if the manager gets sick, gets divorced, or decides to retire. So, okay, very well. In a nutshell, what I want to say is that today, whosoever has an index-related investment in their portfolio could benefit by replacing them with this approach. Now, let's analyze the second possible scenario. Basically, I'm going to change the strategy leverage so my beta goes up to 1. According to the way that the strategy is built, in order to obtain beta equal to 1, I must jack the leverage up to 1.5. And this is what I get. Beta now is 1 and alpha goes to 3.75. This means that while the average return of the index is 7.85%, the strategy will be returning 11.6%. And this with virtually the same beta, which is the same risk as the S&P. Look here, the same happens. You see that at this leverage, when your drawdown goes from 19% to 45%, your beta stays close to 1. And the same happens on both extremes of the chart. Therefore, the same rationale applies. Now I have a strategy that gives me 3.75% above the index, and it presents the same risk on the main range of corrections. For corrections less than 19%, the strategy correction may go up to 22 or 24%, but who cares? And the same happens for corrections above 45%. Well, depending on your application, this may be a good idea. This additional 3.7% per year is not a little thing. Just so you know, I reviewed the last 70 years of the S&P, and during this period, the index yielded close to 19,000%. This strategy would have yielded 210,000%. Now I want to show you another scenario, which is when the leverage of 2 is applied. With this leverage, beta goes to 1.27, which means 27% riskier than the index, and alpha goes to a big 6.62. Actually, leverage 2 is where I started my analysis. For developing the strategy, whenever you adopt an integer for the leverage, you have to calculate much less. Therefore, that's why I like this one. And I tell you, I believe that many people will be more interested in this version than in the other two. And here's the chart for beta. Like you see on the main area, beta will be somewhere between 1 and 1.4, and it grows on both ends. And like I said, a 6.62 alpha for a highly predictable algorithmic strategy is a very, very good number. I am going to show you what it would mean for the last 5 years. The last 5 red years for the hedge funds. Look here. From January 1st, 2015 to December 31st, 2019. S&P 500 index, 58.3%. Strategy, 81.6%. As a matter of fact, this is something interesting that I discovered about the strategy. So far, I did not have the time to investigate any further, but I found out that the higher the leverage goes, you get a better alpha over beta ratio. For the scenario that I just showed, which has a leverage equal to 2, beta went to 1.27, correct? Therefore, if you follow the metrics of the modern portfolio theory, The return should also increase of 27%, but actually it increased much more. It went up 85%. This is alpha of 6.62 divided by the return of the plain index, which is 7.85. Like I said, when I started working on this strategy, I chose to develop the leverage 2 version first. And for this version, I tried to make as many comparisons as possible with the performances of all types of instruments. And of course, my top curiosity was to find out how it would compare with the most reputable and famous hedge funds. Well, unfortunately, I soon discovered that finding reliable performance data on the hedge funds is an uphill battle. Normally, they don't disclose. Or even worse, the real big ones typically disclose the results when they have a good year, but they say nothing when things go south. Therefore, most times, the media tries to get this information from the clients or from some other sources. Well, among the big and famous hedge funds, I only found one which does things differently. This is Pershing Square by Bill Ackman. It is big, it is famous, it is reputable, and best of all, Bill does not hide either his successes or his failures. He openly discloses that from January 2016 to December 2018, his fund had an accumulated loss of 17.5%. In a period when the S&P posted a profit of 30.3%. He also never hid that during this period, his fund suffered a capital outflow of over 60%. On the other hand, he also brags that a couple of months ago he had a position that increased to 100 times value in 1 month. This means an annual percentage profit of 10 raised to 24, which is the number 1 followed by 24 zeros. 1,000,000%. Well, I like this guy and I like his style. He's something like an Elon Musk of the financial world. First, let's compare their overall performance since it was created in 2003. From 2003 to the end of 2019, the S&P 500 yielded 259%. Bill's fund yielded 885%, and my strategy would have yielded 818%. This means a yearly return of 7.5% for the index, 15% for Bill, and 14.1% for my strategy. So you see that my performance is not as good as his. But, for me, the mere fact of having developed something which is comparable to a major hedge fund in terms of performance makes me very proud and honored. And I see 2 issues between the strategy that I'm presenting and Pershing Square which are worth discussing. The first is the fact of the strategy being an algorithmic approach is more predictable. Actually, this happens both for the good and for the bad side. An algorithmic strategy will never profit 1 followed by 24 zeros % like Bill did in March. But, on the other hand, it is more likely to follow the index steadily with an additional alpha not too far from the average of 6.62. And the 3 years of 2016, 17 and 18 are a typical example. We must concede that in these years the index behaved in a pretty unusual way. But even so, it finished the triennium with a yield of 30.3%. My strategy kind of followed the index and yielded 24.5% for the same period. However, Bill Ackman's fund, like the great majority of hedge funds, had a loss of 17.5%. Here I am not stating that following the index up and down like I do is something good or bad. It is very possible that the Pershing Square approach is somehow counter-trend, and I suspect that for the following reason. Since my alpha over these 17 years was 6.6 and the hedge funds was 7.5, and besides, for Bill's fund, 16, 17 and 18 were such bad years. We can infer that during the crisis years of 07, 08 and 09, while my strategy, along with the index, would be visiting the underworld, Bill's fund was somehow spared and did not sink that much. This I don't know for a fact, but it seems that this is what happened. This difference is neither good nor bad. Perhaps the optimum would be diversifying the investment with 50% of the capital on each style. The second issue to be verified would be the comparison between betas. I have already mentioned that for this leverage, the proposed strategy presents a beta of 1.27 with the caveat previously described for very low and very high corrections. I was not able to find Pershing Square's beta. And as a matter of fact, even if I found a number for their beta, it would not mean much unless I knew the details concerning the approach that they used to determine it. However, I dare say that it is pretty hard for me to believe that their beta is less than mine. Based on his history, Bill Ackman seems to be a person that welcomes risky ideas, like his trade of last March. Therefore, it is not likely that the beta for his approach would be less than my 1.27. My conclusion, therefore, is that at this level of leverage, this strategy is definitely a good candidate for a hedge fund. What do you think? And, besides, we can also move the leverage up and down depending on how conservative or aggressive you want to be. So, very well. Basically, this is what I wanted to share this morning. Okay, this is not a live presentation, therefore we cannot have questions and answers, but please don't hesitate to contact me in whatever way you prefer in case you have any sort of questions. And besides, like I said in the beginning, I have much more data than what I showed here, much more analyses and much more results, and also the rationale of the algorithm behind the strategy, and I will be glad to discuss and present all those. So please feel free to contact me anytime, and have a good rest of your day. Bye-bye.